Victor is such a wonderful, I don't even know where to start. Shh. If you're leaving, just leave quietly, please. Victor started his career as a giant business person, doing things that you won't believe when he tells you. When he tells you the businesses that he started from scratch and taken public, businesses that he bid $100 million on and was beaten out by somebody else who had the extra money but didn't have the expertise, and then 2 weeks later begged him to take over the company anyways. I mean, he's gonna just blow you away with stories of his wisdom, his business prowess, his successes, and then he's gonna tell you about this new career that he started, about buying real estate in the United States because of the crash of the market there, and then about his amazing book that he's written to help fellow Canadians go to the United States and take advantage of these gems. He has such a startling story that I'm honored for him to be on our stage here. You're gonna love him, you're gonna learn a great deal from him. He is a person that I've learned an enormous amount from, and I'm grateful that you're here. I love that I helped you with your book. I love how you've created the title of your book with over, upside down. The whole thing is so... Mwah!
Thank you, Raymond.
So wow them like you wow me.
Oh, thank you. Well, after Ryan, boy, I better be good.
Oh, this is the #1 rule of professional speaking: never follow a really good speaker. And so, I'm sorry, Victor. I promise I'll do a better placement job for you next time to even it out. But they'll still love you, even with the contrast with Tiny Trump.
Thank you so much, Raymond.
Thank you.
Well, I'm delighted to be here. And it's been a tremendous experience. I've entitled this talk, Takeover Artist. What I specialize in is turning around businesses. And I'm going to talk to you about real estate today. I'm not your typical real estate guru. I'm not here to tell you about some kind of get-rich-quick scheme or something like that. I'm going to share with you what it is that I do in my business. And we invest in the United States. My company is U.S. Real Estate Partners. We specialize in both developing new properties as well as redeveloping properties in multiple time zones across the U.S. We're right now in 6 different cities. This is a business that we started really only a couple of years ago. Why am I teaching this? I spent about 25 years in the high-tech industry, principally in the semiconductor sector and in the telecom sector. If you ever made a phone call in North America from 1991 onward for about a decade, 52% of the phone calls in North America went through a chip that I designed. So that's my background. That's where I spent the bulk of my career. Spent a lot of time in senior roles, both in public and private semiconductor companies. Companies that we took public. I've raised over a couple of $100 million in capital, and which is not a huge sum of money, but I'm not a beginner at it either, okay? I've completed 4 different corporate acquisitions, done a bunch of different things. I've worked with venture capital, I've worked with private equity, which is much more sophisticated, and most recently wrote this book called The Great Canadian Takeover about how Canadians can invest in the US. The reason I wrote the book is because most of the books on the topic predate 2007, and it's a completely different world out there. Also have an upcoming book called Startupology, and I'll spend a moment to describe that book so that you understand the context of what we'll talk about in The Great Canadian Takeover. Startupology is about how to transform businesses from startup to big business overnight. Now that sounds like an outrageously bold claim. Having been involved in a number of different businesses, having been involved in startup businesses, I discovered that the vast majority of startups actually fail. Only about 10% of startups are successful. And they generally take about 5 to 7 years to achieve profitability. So those are not very good odds. You're actually better off to go to Vegas. You'll do better mathematically, okay? So what I advocate is actually don't do a startup. Startups are actually a bad idea. What you would be better off to do is to go find another business in an adjacent space. Could be a potential partner, potential customer, and go buy that business and use the revenue and profit from that business to fund your startup. It's actually a lot easier to raise $300 million to buy an existing business than it is to raise $5 million for an idea. And then once you have that underway, it's now a business turnaround. It's not a startup anymore. It's a much stronger value proposition. It's a lower risk profile. You've accelerated the entire process to profitability by about 5 years. It's just a better way to build a business. Okay? So that's just the backdrop, and now we're going to switch into real estate. So I want you to view everything I'm talking about here through the lens of business turnaround, because even real estate investment businesses are business turnaround type businesses. You can get money in basically 3 different ways: earned income, residual business income, or capital gains. The vast majority of wealth in the world was created in either residual business income or capital gains. It's one of those two. It's not in earned income because there just aren't enough hours in the day for you to make money that way, at least not big money. And investment in real estate is a business, like any other business. I know how to make a hamburger. Put up your hand if you know how to make a hamburger. Well, that doesn't, how come you're not McDonald's? I'm not McDonald's. What made McDonald's McDonald's is when Ray Kroc bought the original McDonald's locations from the McDonald brothers, he didn't focus on burgers. He focused on the systems, the processes to scale the business to what it became today. And it's the strength of those systems and processes that enable a McDonald's franchise that's pulling in $4 or $5 million a year in revenue to be run by 18-year-olds. So he focused on systems. And that's what we do in investment businesses as well, is focus on systems, scalability, process. Let's talk about cause and effect. We all know what that means. How many of you own shares in public companies, maybe on the TSE or New York Stock Exchange? Do you feel like you're in control of your investments? Not at all. So when the market goes up, you make money. When the market goes down, you lose money. The market valuation is the cause, and you are on the effect side of that equation. You're not in control. I prefer to focus on value creation, because then that puts me in control. Maybe you might say, Victor, you're a control freak. That's okay. But if I'm creating value, then the effect is I'm making more money. That's something I control. I'm not left to the vagaries of the marketplace. So this is a property we purchased in Philadelphia. It's about 6 or 7 blocks from Temple University. It was a vacant lot we purchased for $6,000, and it was zoned single family. As a single family lot, it wasn't worth much. We owned another property a couple of doors down that was a multifamily building, and we got this rezoned after a couple of months of work, rezoned multifamily, and we built a triplex on there. And we just refinanced it back in May for $410,000. Okay, that's value creation. Okay? Question is, what's a good deal? A lot of people think that deals are found. I actually don't believe that. I believe that most deals are actually created. This is an example of a property we did. This is a waterfront property in Palm Harbor in Florida. We just completed. We tend to do a lot of waterfront properties. It was owned by the bank. They were asking $220,000. We offered $170,000. They came back at $210,000. We went back at $180,000. And then they said, give us your highest and best offer, because we have multiple offers. So we thought about it, and we knew our maximum bid price was around $190,000. So we offered $191,200. So a little bit above what we thought the others would do, and we secured the property. Okay, so now we're in due diligence. We're conducting inspections, and we discover termites in the property. Pictures on the top are what it looked like before, and pictures on the bottom are what it looked like after. So there were termites on the property, and we said, well, Mr. Lender, Mr. Seller, you need to solve the termite issue. You need to give us a 5-year transferable warranty on the termites, and the price has to drop back down to $170,000. They said yes to the termites, they said yes to the warranty, and then they said, we'll give it to you at $175,000. So we said, okay. Then they came back and said, can you close in 2 weeks? And we said, sure, the price has to drop to $172,000. Okay? We got a $48,000 discount simply through negotiation. Now, this is not a bad deal. We'll make $100,000 profit on it. But we made $48,000 of that through negotiation. We didn't find the deal, we made it. Okay? Just in case you think this is a fluke, these are just a sampling of other projects that we've done over the last 12 months. The rates of return are quite decent. I was doing the math just before this presentation. We did 48 transactions in the last 12 months. So we have a system. This is what we do day in, day out. What can go wrong? This is not a get-rich-quick scheme at all. This is hard work. This is a property in Oak Park, which is a suburb of Chicago, very affluent suburb. We bought this house as a tax sale for $92,000. The original plan was to put about another $100,000 into it, so total investment would have been $190,000. We expected to sell it for $320,000. This was mismanaged. We had cost overruns. We had delays. We sold the property more than once because the buyer actually failed to qualify for their financing, so we had to sell it multiple times. And at the end of the day, we only made $13,000 profit. This should have been a home run. It was not. Now, fortunately, we didn't lose any money. But a good deal, badly managed, is no deal. So investment comes back to always, what is the strength of your team? Because it's the team that's going to be managing the work on the ground on a day-to-day basis. So when I focus on building my investment business, I focus not on properties, because deals are everywhere. I focus on the team. I focus on building the strength of the team. Let's talk about raising capital. Put up your hand if you own real estate or if you're a real estate investor. Okay, so quite a few of you. How many of you could use with a little bit more money? Absolutely. So what is the one, I'd like to hear from a few of you, what is the one thing that's holding you back from doing more in real estate? Anyone? More capital? Okay. That's not surprising. I started out in the investment world spending my own capital, and real estate is a game with big numbers, and eventually everybody runs out of cash. So what I needed to relearn how to do after having learned how to raise money in the high-tech industry was to apply that skill set in the world of real estate. And so now I don't spend my own money when I'm buying real estate. I bring in other funding partners and I work with them. Even though I could choose to spend my own capital, I choose not to. And now that's unblocked and it's made it possible for me to scale my business significantly. There's 4 principles on how to raise capital. Number 1, all good deals get done. And I really mean that. All good deals get done. The only question is, who's going to do them? Is it me? Is it you? Or is it the next guy? But all good deals will get done. Second is relationship. We'll spend a little bit more time on each of these items. So relationship, trust, and results. Those are the 3 remaining factors that enable you to raise capital easily. So first question is, what's a good deal? Have you ever heard someone say, I had a great deal, but I couldn't get it funded? Yeah, you hear that all the time. Well, if they couldn't get it funded, then chances are it probably wasn't a good deal. There was something about it that the lender looked at or the funding source looked at and said, there's something about this that just doesn't feel right. So when someone says, I had a great deal, but I couldn't get it funded, I say, then it probably wasn't a good deal. Or it didn't fit. It didn't fit that funding partner's criteria. Relationship, and I want to focus on the word relationship here, is not about contacts. It's not about networking. It's not about, there's nothing mercenary about relationship here. It has to be absolutely genuine. Would you lend some of your money, some of your hard-earned cash to someone that you didn't have a genuine relationship with? I wouldn't. Most people wouldn't. So the focus has to be on building relationships. Building relationships first and foremost for the sole purpose of building relationships and nothing else. And once you have that, then there may be a potential down the road to do business together. But it starts with relationship. Trust has a lot of layers to it. It's probably the most important thing. It is the foundation of raising any capital. But it's a whole list of questions. Can I trust you with small commitments? Can I trust you to ask the right questions? Can I trust you to put together a good plan? Can I trust you to execute the plan? Can I trust you to communicate frequently and openly when there's an issue? Can I trust your systems? Can I trust you to hire the right people? Can I trust you with my money? And can I trust you when I'm not looking? And if any one of these items is missing, you know what? It doesn't work. It just doesn't work. Can I give you some homework? Yeah? Have you heard of Stephen Covey? Stephen Covey was the author of 7 Habits of Highly Effective People. This book is by his son, Stephen M.R. Covey, and it's called The Speed of Trust. And if you read this book and internalize it, I promise it will change your life. You will never, ever view relationships the same way again. You will view business relationships differently. You'll view personal relationships differently. Okay? You can get it at Amazon. You can get it at Chapters. If you go to get it at Chapters, ask the staff. They have it misfiled in the wrong section, so it's hard to find. Okay? And then the final element, results. What have you done? Show me that you know how to be successful. Who have you got on your team? Now you might say, well, how can I raise capital if I don't have any results? And how am I going to get results if I don't have any capital? I'm in a catch-22 and cannot escape that reality. Well, remember, business is a team sport. Nothing says that you have to do it all by yourself. This is not like a high school exam. Partner with somebody that has a successful track record. Now you can borrow some of their track record. You can borrow from some of their success because of association. When you're working with someone else's money, you have a fiduciary responsibility. That comes, and it's not just morally, it's actually legally as well. If you don't fulfill your fiduciary responsibility, bad things can happen, and they give you this orange uniform to wear. Okay? You have a duty to disclose. You have a duty to disclose the risks, any problems, any decisions that you make. So that comes part and parcel with using someone else's money when you are investing in a project. There's lots of different sources of money. You can get money many, many different places. You can get them from private investors. There are something called mixed mortgage investment corps here in Canada. They go by a different name in the States. There are private equity firms. A lot of them are called hedge funds these days in the U.S. as well. There are banks, hard money lenders. There's many, many, many different sources of capital, and you have to figure out how to work with each of those. There's a bunch of laws that you need to figure out and navigate. In Ontario, we have the Ontario Securities Commission. In the U.S., there's the SEC. In Alberta, there's the Alberta Securities Commission. And these dictate the way that you can engage with investors. And you have to follow those rules. Did you know it's against the law to ask for money? It is. How many of you actually would be uncomfortable asking for money? Okay, well, that's good. I get a lot of people to invest with me, and I tell you, I never, ever, ever, ever ask for money. What I do is I offer people the opportunity to collaborate on a project. Now, that's a completely different posture. Doesn't that feel so much more natural? There's many different structures you can use when you're putting together a project. I won't go through all of these right now, but there's a lot of choice. It's this huge menu of options that you have, and work with your legal team to put together the right structures so that you have the right fit for your funding sources in the project. In the US, the banking system is much more complex than it is here. They have over 6,000 banks compared with the 5 large banks that we have in Canada. Canadian banks compared to US banks are actually very large. Most of the banks in the US are tiny. And I generally prefer not to work with the large banks. I prefer to work with the smaller institutions because you can go in there, establish a relationship at the executive level, get the executive comfortable with what you're doing, and then they will work with you on multiple projects. Turns out it's actually very easy to raise capital once you've developed the right relationships. You've all heard the term, the proverbial no money down deal. How many believe that that's true? How many, do you believe it's true? Yeah? And how do you believe it's actually very difficult to do? No? Here's how we do it in our business. I'll show you just one example. But the numbers are the same. It doesn't matter whether we're talking about a 4-unit building or a 60-unit building. It's the same formula. What we do, this example here is a fourplex that's currently under construction in Philadelphia. This is a new build. About 60% of what we do is new construction. The total investment in the property is $322,000. We bought the property for $45,000. Our construction cost is $260,000. We've got some holding costs. And the reason for that $422,000 is it's an important number. Sorry, $322,000. The reason that's an important number is because that is at 70% of the appraised value. We expected the appraised value to be $460,000. So we can go back to the bank once construction is completed and refinance at 70% of appraised value. So if we only invested 70% of the appraised value and we refinance at 70%, we get back all of our invested cash. And now we're left holding a cash flowing property with zero cash tied up in it, and we still have 30% equity. That's a no money down deal, by my definition. Now, yes, we do need to raise capital for a year, but that's not a very expensive thing to do. Okay? And then you can do this over and over and over again. See a lot of investors making very, I'll call them classic newbie mistakes when they approach a funding partner. First of all, they don't know questions to ask. Or sometimes they hand this big stack of paper in front of the funding partner. See, look, I've done all my due diligence here. Look at all this stuff. And the funding partner, someone with wealth, doesn't know if they want to spend even 10 seconds on this, let alone wade through this stack of paper. So what should you do? Give them the 10 seconds. It's that simple. Just give them the 10 seconds. And then decide from there if it's worth having another conversation. So for example, if we went back to this deal and I was approaching a funding partner, I would say, I have a fourplex in Philadelphia. It's a new construction build. It's going to generate $16,000 a year in positive cash flow. We're going to tie up about $80,000 in cash for the first year. When we refinance, you get all your money back, and you'll get a share percentage in the property. Are you interested in learning more about it? That's it. That's the 10 seconds. Not very complicated, is it? And then if they're interested in learning more, then we can certainly talk about what it is that would fit for them. How would you like to be involved in the due diligence? This is what we plan to do in our due diligence process. Can you see anything else that you would like us to do? And from there, you then decide if there's a fit for their capital or not. So what I've learned to do is I've learned how to raise capital. I do this each and every day. This is what I do. That's what I focus on every day. We do a lot of projects. We figured out how to comply with the laws against solicitation, how to find multiple different sources of money. Today in my business, I think we have about 17 or 18 different funding partners that we work with. We know how to structure deals, know how to create no money down deals, when to secure a debt partner versus an equity partner, how to structure these projects. We've learned how to make the seller our partner. Many times the seller who thinks they just want cash for a property can actually be a great partner. These are all the tools that are essential to raising capital. Is this something that you'd be interested in learning more about? Yeah? Okay. The purpose of this event is not to sell stuff, okay? So we're not selling anything. I will be holding a workshop here in Toronto on November the 16th. You can write down that date. If you want to find out more about it, come see me at the bookstore at the break. We'll give you more information. But this is what we do, and I'm happy to teach a one-day workshop on how to do this. Okay? Let me open it to any questions. We have a couple of minutes remaining. Question was, as a Canadian, did we do this through a Canadian corporation, or do we set up any U.S. entities? We actually have a number of entities, and we have a very specific cross-border structure that we use in order to prevent double taxation. The cross-border tax rules are a little bit complex. Obviously, everyone's situation is individual, so you got to get your own accounting advice. The structure we use is Canadian corporation owning shares in a limited partnership, a U.S. limited partnership, and that seems to be, for us, at least the best structure.
Which city and states are you finding the best properties?
So right now we're active in 6 different cities. We're in Chicago, Philadelphia, Tampa, Phoenix, New Jersey, and we're just starting a very large project in Dallas. There are, frankly, the U.S. is an all-you-can-eat buffet of opportunity. It really is. So it comes down to getting the right teams in the right locations. Now, there are certain cities I won't invest in. I won't invest in Detroit or Cleveland because those are shrinking cities. I want specific situations where there's population growth, economic drivers. I want to see a mismatch between demand and supply. I want strong demand and weak supply. Same business principles you would apply for any business. Those are the conditions that I look for. So for example, Philadelphia, we're doing student housing right in the shadow of Temple University. In Dallas, we're building student housing in the shadow of UT Arlington. So it's always those types of situations. The question was, which do I prefer, Canada or the US in terms of investment, correct? I started out investing in Canada, and there are good opportunities in Canada. The choice I've made is to start divesting in Canada and repurposing that capital in the US, simply because I see more opportunities, I see much greater value in the US. We can buy things for pennies on the dollar in many cases, and it's much harder to do that here. You know, we buy stuff typically at 40 cents on the dollar. We'll put maybe 20 cents into it and sell it for 90 cents on the dollar. I'm always looking for 25 to 30% net profit margin on anything that we do. Good question. So the question is, do I actually physically go down and look at properties, or do we have teams in each location? We have teams in each location, and when I travel, I don't go to look at properties. I go to set up the teams and strengthen the teams. So we actually have, each city is a standalone business, so to speak, where we have investment management, we have property management, we have construction management. It's very management heavy, and then everything falls underneath that. So for example, my team in Chicago, it's a staff of 17 people. It's not small, it's significant. Philadelphia, we're 5 people, and so on. So it's always about the team. No different than if you were looking to set up a restaurant or a hotel or any other business in a remote city, you got to have a team, and we view it the same way.
Okay, if you have more questions for Victor, and I suspect that you do, please simply see him at his booth, at his bookstore booth. He has a booth at the back. And Victor, thank you. You did a great job. Thank you. Thank you. Thank you.